Dividends and share repurchase analysis. So dividend policy affects company's value and signal investors and signals investor get from dividend changes is something we are now going to look at. Payout is broader than dividend and includes special dividend, stock repurchase, etc., by which companies can pay out cash to stockholder. So in recent times, the firms are more towards the stock repurchase option, making this a contemporary and something that is in trend and would go on, especially in times of both during the recession and the boom. So sustainability of dividends and coverage ratio is again depends on the firm's payout policy. So compare theories of dividend policy and explain implication of each for share value given a description of corporate dividends. So dividend irrelevance. Now maintains that the dividend policy is irrelevant and it has no effects on the price of the firm's stock or the cost of capital. MM's argument of dividend irrelevance is based on concept of homemade dividend. Assume, for example, you are a stockholder and you don't like the firm's dividend policy. If the firm's cash dividend is too big, you can just take the excess cash received and use it to buy more company stock. If the cash dividends you received was too small, you can just sell a little bit of your stock in the firm to get the cash value you want. In either case, the combination of the value of your investment will be the same. So the dividend irrelevance theory hold only in perfect world with no tax, no brokerage cost and indefinitely divisible shares. You also note that the MM discussion pertains to the firm's total payout policy rather than to the narrow dividend policy. Then we have the bird in hand argument for dividend policy. When MM concludes the dividends are irrelevant, this means that investors don't care about the firm's dividend policy, is that they can create their own. If they don't care, firm dividend policy will not affect the firm's stock price. Consequently, dividend policy will not affect the firm's required rate of return. Now, there is another argument that says that RS or the return of equity decreases as the dividend payout increases. Why? Because investors are less certain of receiving future capital gains from the reinvested return earning than they are receiving the current. The main argument of Gordon and Linter here is that an investor places a higher value on dollar dividends than they are to certain received $1 of expected cash flows. As the name suggests, something in hand is better than not having something at all. So the dividend yield is D1 upon P0, and while measuring total returns, the dividend yield component has less risk than the growth risk component. Then we have the tax aversion. In many countries, dividends have historically been taxed at higher rates than capital gains tax. In 1970s, US taxes on dividend income was as high as 70%, while tax on capital gain was 35%. In late 1990s, the rate were much lower, but the same general relationship was still in place. Dividends are taxed as ordinary income with rates as high as 39.1%, while long-term capital gains are taxed at 20%. Under such situation, according to tax aversion policy, the investors will prefer to not receive dividend due to their higher tax rate. Taken to the extreme, the tax aversion theory implies that investors would want companies to have a zero dividend payout ratio so that they will not be burdened with higher taxes. In real world, tax law often prevent companies from accumulating excess earning, making dividend payment compulsory. Also, the note in 2003 that the tax laws in the United States changed so that the dividend and long-term capital gain are both taxed at 15%. So what's the conclusion from the three theories? The result of empirical tests are unclear as to which of the three theories best explain the empirical observation of the dividend policy. Research suggests that higher tax rate do result in lower dividend payout in US. However, changes in tax law that puts dividend and gain on common ground is more likely to make tax aversion theory relevant. There is empirical support for bird in hand theory, as some companies that pay dividends are perceived less risky, and specific groups of investors do prefer dividends paying stock. Now MM counter this by saying that different dividend policies apply to different clienteles, and since all types of clienteles are active in marketplace, dividend policy has no effect on company if clienteles are satisfied. So now let's look at the information or the signals that dividend initiation, increase, decrease or omissions may convey. So this is about the signals. So information asymmetry refers to difference in information available to companies board and management, and the management are also the insiders and the investors are like the outsiders. Dividend convey more credible information to the investors as plain statements. This is because dividends entail actual cash flow and expected to be sticky, continue in the future. Companies refrain from increasing dividends unless they expect to continue to pay out higher dividends in the future. Similarly, companies don't like cutting dividends unless they expect that lower level of dividend reflects long run poor prospectus of company in the future. The information conveyed by dividend initiation is ambiguous. On one hand, the dividend initiation could mean that a company is optimistic about the future and sharing its wealth. That's a positive signal. On the other hand, the initiative could mean that company's lack of profitable reinvestment opportunities, a negative signal. An unexpected dividend increase can signal to investors that company's future business progress are strong and the managers will share the success with shareholders. Studies have found that companies with long history of dividend increase such as GE, ExxonMobil are dominant in their industries and have high returns on assets and low debt ratios. Unexpected dividend decrease or omissions are typically negative signals that the business unit or management does not believe that the current dividend can be maintained. In rare instances, however, dividend decrease or omission can be a positive sign. Management may believe that profitable investment opportunities are available and that shareholders would ultimately receive a greater benefit by having earning reinvested in the company rather than being paid out as dividend. So again, we have both the views here. Other dividend policy theories. So explain how clientele effect an agency issue may affect a company's payout ratio. So clientele effect, this refers to varying dividend preferences of different groups of investors such as individual, institution and corporations. The dividend clientele effect says that different groups desire different level of dividend. Rationales for the existence of clientele effect include tax consideration. Higher tax bracket investors like some individuals tend to prefer low dividend payout, while low tax bracket investors may prefer high dividend payout. In the presence of differential tax on the dividends and capital gains, investors would be indifferent between receiving dividends. So then we have a formula here which says that $D into 1 minus T upon 1 minus TCG in capital gain. In other words, when stock goes X dividend, we have a change in price and that price is dividend into 1 minus TD upon 1 minus TCG. Let's look at an example here to understand this more closely. So a firm is planning to declare $12 in dividend. The tax rate for marginal investor is 15% and tax on dividend is 30%. Compute expected drop of price. Suppose the tax rate on capital gains TCG is 25% and the stock price of the company falls by 85% of the dividend amount on an average when stock goes. What is the tax rate on dividend for a marginal investor? So it depends on two things: the tax on the dividend and the tax which is the capital gain tax. So expected drop in price is the dividends into 1 minus 0.3, that is the tax on dividend, whole divided by 1 minus 0.5, which is the tax for marginal investors or the tax for capital gains. So on the numerator we have 1 minus TG and on the denominator we have 1 minus TCG, and we can calculate. So that would be if a company is declaring $12 in dividend, then the price drop will be 9.88. So hence $1 of dividend is worth less than $1 of capital gain. So again this can also be observed with the tax. So if dividends are taxed higher, it's a wrong idea to pay dividends. So both of them are not the same. Then we have to calculate if the cost of dividend. We can reverse this formula. If you closely look at this, on top you have the tax rate on dividend, and if there is no tax on the dividend, then it would be 1 minus dividend upon 1 minus TCG. So then it's the stock price would actually increase. So if you give some dividend, your stock price or the delta would be higher. So that's where we are coming from. If you look at it, stock price change into 1 minus tax rate is equal to dividend into 1 minus dividend rate, or in the other words, that price would fall, and the dividend, if the same amount that would change in price would be the same amount, that would be dividend and taxed. So the left and the right hand side should be equal. Then we have the requirement for institutional investor. For legal or strategic reasons, some institutions investor will invest only in companies that pay dividend or have dividend yield above some threshold. Examples are dividend focused mutual funds, and some trusts are required to hold dividend paying stock. Individual investor preferences again another thing. Now let's look at agency issuances, and then we'll look at how to work around with dividends in a detailed way. So agency issuance between shareholders and managers. Agency cost reflects the inefficiencies due to divergence of interest between managers and stockholders. One aspect of agency issue is that managers may have an incentive to over invest or empire building. This may lead to investment in some negative NPVs, which reduces the stockholder wealth. One way to reduce agency cost is to increase the payout of free cash flow as dividend. Generally, this makes sense for growing firms to retain large proportion. However, mature firms or in cyclic industry do not tend to hoard cash. In such cases, high dividend payout ratio would be welcomed by investors. So this depends on the cyclicity and whether it's a growing company or a mature company. Now, agency issues between shareholders and bondholders. For the firm financed by debt as well as equity, there may be agency conflict between shareholders and bondholders. When there is risky debt outstanding, shareholders can pay themselves a large dividend, leaving the bondholder with lower assets as collateral. This way, there would be a transfer of wealth from bondholder to stockholder. Typically, agency conflict between stockholder and bondholder is resolved via provisions in bond indenture. If you remember this word bond indenture, it is the rules which has all the rules on what you can do, what you cannot do. So that is the bond indenture rules and the constraints and the covenant that are there for the company when it takes some debt. Now explain the factors that affect dividend policy. A company's dividend payout policy is the approach a company follows in determining the amount and timing of dividend payment to shareholders. And there are 6 factors that affect company's dividend policy. Investment opportunities, expected volatility of future earning, financial flexibility, tax consideration, flotation costs, and contractual and legal restriction. So in investment opportunities, that's quite simple. Expected volatility of future earning. Firms tie their target payout ratio to long-term sustainable earning and are reluctant to increase dividend unless reversal is not expected. Hence, while earnings are volatile, firms are more cautious changing dividend payout. Financial flexibility. Firms with excess cash and desire to maintain financial flexibility may resort to stock repurchase in case of dividend as a payout excess cash. Since stock repurchase plans are not considered sticky, there is no implicit expectation by market on an ongoing repurchase program. They don't entail reduction in financial flexibility going forward. Having cash on hold after company's flexibility to meet unforeseen operating needs of operations. Tax consideration. Investors are concerned about after-tax return. Investment income is taxed by most countries. However, the way the dividends are taxed vary from country to country. The method and amount of tax applied to a dividend payment can have significant impact on firm's dividend policy. Generally, in countries where capital gains are taxed at favorable rates as compared to dividend, higher tax bracket investor fund will prefer low dividend payout. So this is something that we were looking using those formulas. Now moving ahead, flotation cost. When a company issues new shares of common stock, a flotation cost of 3 to 7% is taken from the amount of capital raised to pay the investment bankers and cost associated with new stock. So that is a high percent, 3 to 7%. Now since retained earnings have no such fee, the cost of new equity is always higher than the cost of retained earnings. Large companies especially have lower flotation cost as compared to smaller. Generally, higher the flotation cost, the lower is the dividend payout ratio. The need for equity capital is in positive NPV project. Contractual and legal restriction. So there must be some legal reason. The impairment of capital rule. A legal requirement in some countries mandates a dividend cannot be in excess of retained earning. That means you cannot take debt to pay the dividends. Debt covenants. There are designations to protect bondholders and dictate a company must do and must not do. Many covenants require a firm to meet exceed target for liquidity ratios, exempt current ratio and coverage ratio before they can pay a dividend. So even your debt indenture or your term debt could have things that might stop you from going on and increasing the leverage. The next point, calculate and interpret the effective tax rate on a given currency, unit of corporate earning under double taxation, dividend imputation and split rate tax system. Dividends paid in the United States are taxed according to what is called double taxation system. As you can see, it's based on the idea that you will be taxed two times. In 2003, new taxation was passed in the United States that reduced the maximum tax rate on dividends of individual level from 39.6 to 15. So this happened in 2003. Since dollar of earning distributed as dividend is first taxed at corporate level and after corporate tax at individual level, we can calculate the effective tax, which is corporate tax plus 1 minus corporate tax into individual tax. So it's a bad idea to due to this dual system. So if you look at this formula, let's try to understand this with number. A company's annual pre-tax earning is 300. The corporate tax rate on retained earning is 35. The corporate tax rate applied to earning payout on dividend is 20%. Assuming company pays out 50% of its earning as dividend, the individual tax rate applies is 30%. Calculate effective tax on the euro of corporate earning paid out as dividend. So the corporate tax that applies to payout is 20%. So you will have this 20%, and plus you will also be having the individual tax rate 30%. So the rest of the 20% it would be sticking to you. So it would be 1 minus 20 into 30%. So the over effective tax rate on income distributed as dividend is 44%. So the 1 minus 20, the rate that applies to earning paid out is 20%. So it will be always greater than 20%, and the rest is that is being given to the individuals. So this is the reasoning. Now again you can derive this in the long way, where you can actually go ahead and calculate the long term and derive this equation. So you can do earning minus tax, earning after tax, dividend payout ratio, tax on dividend, tax paid to investor, and when you will do, you will get to the same formula, which is the corporate tax rate plus 1 minus corporate tax rate into individual tax rate, which is the effective tax that you have to pay on dividends. Now compare stable dividend, constant dividend payout ratio, and residual dividend or payout policy, and calculate a dividend under each policy. So you could give dividend in different policies. You can give constant, residual, or the remaining one, or you can give some payout ratio. A stable dividend policy focuses on steady dividend payment even though earnings may be volatile from year to year. Companies that use stable dividend policy typically look at forecast of their long-term earning to determine appropriate level of stable dividend. This means aligning the company's dividend growth rate with company's long-term earning growth rate. A stable dividend policy could be gradually moving towards a target dividend payout. A model of gradual adjustment is called target payout ratio adjustment model. So if company's earnings are expected to increase, now this is the target payout ratio, then the formula here becomes expected dividends is equal to previous dividend, expected in increase in EPS, target payout ratio plus an adjustment factors. Adjustment factor is 1 over number of years over the adjustment in the factors will take place. Let's look at an example to clear this out. So if they have an earning of 3.50 per share and they paid a dividend of 0.7, the company expect to earn 4.50 per share. The company has 35% payout ratio and plans to bring it in 5 years. Then it would be previous dividend plus increase in expected into, so whatever is increase, you are going to multiply it in the target payout ratio so that you can get the target, and then you have to multiply it by 1 by T. Then we have constant dividend payout ratio policy, which is payout is the percent of total earning paid out as dividend. The constant payout represents the proportion of earning that a company plans to pay out to shareholders. A strict interpretation of constant payout ratio method means that there is company would pay specific percentage of earning and the amount of those dividends would vary directly with earning. This practice is seldom used. Residual dividend models. In residual dividend models, the dividends are paid based on the final funds that is left. So dividends are based on earning less funds the firm retained to equity portion of capital. The model is based on investment opportunity of the scheduled target capital structure and access and cost of external capital. So there are few steps to determine the target payout ratio, dividend per share divided by earning per share. Identify the optimum capital budget. Determine the amount of equity needed to finance that capital budget. Meet equity requirement to the maximum extent possible with retained earning. Pay dividend with residuals earning that are available after needs of optimal capital budgeting are supported. In other words, the residual policy implies that dividends are payout of the leftover earning. So that is the residual payout policy. Now we move to explaining choices between cash dividend and repurchase program. So we have discussed dividend policy approach. It is important to point out that share repurchase program can be important part of payout policy. A share repurchase is a transaction in which company buys back share of the common stock. Since shares are bought using company's own cash, a share repurchase can be an alternative to cash dividend. So there are 5 common rationalities for share repurchases versus dividend: potential tax advantage, share price support signaling, added flexibility, offsetting dilution from employee stock option, and increasing financial leverage. So we could do the share repurchase and get these benefits. Now broader trend in corporate dividend policies is something that's happening in recent time. So dividend policy has been sent to different across countries over time. This probably has to account for difference in investor preferences as well as changing investor preference over time. The following generalization can be made with respect to global trends in corporate dividend policies. A lower proportion of US companies pay dividend as compared to European counterpart. Globally, in developed market, the proportion of companies paying cash tends to tended downward in the long term. The percent of companies making stock repurchase tending upward since 1980, and it has been at an all-time high in recent time. Now the other thing that we have to now look is calculate and interpret dividend coverage ratio, net income and free cash flow. Identify characteristics of companies that are not able to sustain their cash dividend. So dividend safety is a metric used to the dividend safety is a metric used to evaluate probability of more dividends continuing at current rate for company. Traditional ratios such as dividend payout ratio, dividends divided by net income, or inverse dividend coverage ratio, net income divided by dividends, are typically used for this purpose. Higher than normal dividend payout ratio and lower than normal coverage ratio tend to typically indicate probability of dividend cut. Analyzing these ratios, we should compare the computed ratio to average ratio for the industry and market within which the company operates or the same sector. In making a qualitative judgment about companies, stable or increasing dividends are looked upon favorably, whereas companies that have cut dividends are looked upon as unfavorably. Another ratio could be used using FCFE. FCFE is cash flow available to stockholders after working capital and fixed are met. So FCFE upon dividends plus share repurchases is FCFE coverage ratio. So I think that was it for the dividends and the share repurchase. Hope this was helpful. Thank you for listening.